Instruments. Just by way of introduction, I am David Mokwena. I am a qualified chartered accountant and a lecturer at Endunamu. My experience spans over 7 or so years post-qualification, much of which has been in lecturing and partly in commerce and industry, where I work as an IFRS specialist. And I'm delighted to have you guys here this evening, Tabisa and Okoshe. I'm hoping we'll have more people come in to join us, but because we're a small cohort, we stand the advantage of having an intimate session where you guys are able to ask questions. In fact, I invite you to please, if at any point during the course of the lecture, you seem to not be understanding anything, by all means, you are welcome, you're invited to raise your hand and just ask me a question. We have the liberty of doing this. And because financial instruments is quite an intricate part of corporate financial reporting, I expect that there will be parts where you would like to get clarity, and that's what we are here for today. And because I cannot see when your hands are raised up in the background, I also welcome you guys to just simply unmute yourselves and pause me if you've got any question or any point of clarity prior to just simply choosing to raise your hand. I will not see your hand from this point onwards. So yes, please just unmute and go ahead with your questions. So financial instruments is a portion of our corporate financial reporting that is made up of a number of complementary standards that work together. The first one being IAS 32, followed by IFRS 9, which talks to a whole lot of things such as classification, measurement, initial recognition, etc. And then finally IFRS 7, which speaks to the disclosure of financial instruments. So IAS 32, IFRS 9, and IFRS 7 are standards that you find in the entire complement of your IFRS standards. But for purposes of your course, you are not expected to be covering the entire complement of the financial instrument standards. The only parts that you're expected to cover and understand are what we're going to cover in today's session. Just to give a bit of context for today's session, when you are presented with a set of financial statements like we have been here, we have a sample of consolidated statement of financial position. This is for Shoprite Holdings as at 3 July 2022. Looking at the set of financial statements, you would find under the non-current assets, you'd find typical financial instruments such as your loan receivable. And under your current assets, you would also see the current portion of your loan receivable, your restricted cash, as well as your cash and cash equivalents. Moving along within the equity part of things, you would find stated capital and treasury shares sitting there as one of, or as classes of financial instruments. And moving further down along the statement, you would find under your non-current liabilities, financial instruments such as borrowings, and the borrowings would then be split into its current portion as well as its non-current portion. But before we get to actually having what we ultimately see in the financial statements, we need to meet a set of criteria that we're going to discuss today. These are classification criteria as well as measurement provisions and further criteria that speak to the initial recognition and subsequent recognition of financial instruments. But ultimately, having applied all of the requirements, this is what we expect to be seeing when a set of financial statements is prepared. Coming to the presentation of financial instruments, our objective tonight is to identify and account for financial assets and financial liabilities. We also expect that you should be able to measure financial assets and financial liabilities on initial recognition and subsequently. The expectation is that you'll be able to apply the provisions of the standard to distinguish between what qualifies as equity and what are liabilities as defined. We expect that you will understand when you, as a preparer of financial statements for an entity, are allowed to offset financial assets and financial liabilities. And finally, we expect that you will be able to identify and account for derivatives. Now, in IAS 32, we have an overarching standard that talks to the presentation of financial statements, and this is a standard that exists to establish principles for presenting financial statements either as liabilities or equity, as well as for the offsetting of financial assets and financial liabilities. The standard would apply to the classification of financial instruments from the perspective of the issuer. And this is very important. With financial instruments, ladies and gentlemen, you always classify them from the perspective of the issuer. The issuer in this case is the person who drafts a contract, offers it over to another person. The other person becomes the other party, the contracting party, who signs the contract and holds the contract. So the issuer is the person from whose perspective we need to classify financial instruments. And the standard applies to classify these financial instruments into financial assets, financial liabilities, and equity instruments. It also speaks to the classification of the related interest, the interest related to financial liabilities, the dividends related to financial liabilities and equity instruments, as well as any losses and gains pertaining to financial liabilities and equity instruments. And it also applies to circumstances in which financial assets and financial liabilities should be offset when we are presenting financial state or when we're presenting financial instruments in our financial statements. Now, the principles of IAS 32, as I discussed at the beginning of the session, are complementary to those found in IFRS 9, as well as those found in IFRS 7. Now, when coming to our definitions, which are very key, the first definition that we need to understand is that of a financial instrument. So first and foremost, a financial instrument has to be a contract, and a contract that gives rise to a financial asset in one entity's hands and a financial liability or equity in the hands of another entity. So firstly, we need to have a contract, and we know that contracts are either explicitly agreed or they stem from common business practice and are agreed to either explicitly in black and white or as per common business practice. And once a contract exists, you need to be able to demonstrate that that contract creates a financial asset in one entity's financial statements and a financial liability or an equity instrument in another entity's financial statements. Another definition that we need to be well averse with, or au fait rather with, is a derivative. A derivative is a category of financial instruments, but one that has the following characteristics. Firstly, its value should change in response to the change in a specified interest rate, financial instrument price, commodity price, or another variable, provided that in the case of a non-financial variable, that variable is not specific to a party to the contract. We are going to discuss this further towards the end of the session when we deal with derivatives. We'll come back to this definition and just see how it applies and how the different classes of derivatives actually qualify to meet the definition of a derivative. So one, the value of a financial instrument, for a financial instrument to be a derivative, its value should change in response to the value of an underlying variable. Secondly, it should require no initial or a little net investment. And thirdly, it should be settled at a future date. So it needs to meet all three of these criteria, or it should have all three of these characteristics for it to be a financial instrument that is classified as a derivative. Just now, we spoke about the fact that a financial instrument is a contract that gives rise to a financial asset in one entity's hands and a financial liability or equity instrument in another entity's hands. Let's now define what a financial asset is. A financial asset, by definition, is any asset that is cash or an equity instrument of another entity. So when we talk about an equity instrument of another entity, we are talking about the entity that is holding this financial asset, and the financial asset is a share in another entity. If you take, for example, yourself, if you were to go to the JSE and buy shares in Shoprite Holdings, the shares that you've purchased would be an equity instrument of another entity that you have now entered into a contract to hold. And because you are holding it in your financial statements, that equity instrument of the other entity being ShopRite would be a financial asset. The third definition of a financial asset is that it is any asset that is a contractual right to receive cash or to receive another financial asset of another entity. So a contractual right to receive cash, or if you have a contractual right to receive shares, that contractual right on its own would be a financial asset. Alternatively, if you have a contractual right to exchange financial assets or to exchange financial liabilities with another entity under conditions that are potentially favorable to yourself as an entity, then you have a financial asset. Any questions so far? No questions. Okay. Now moving over to another set of financial instruments, we have financial liabilities. A financial liability to begin with has to be a liability. And it is a liability that is a contractual obligation to do what? To deliver cash or to deliver another financial asset to another entity. So when you have a contractual obligation to make a payment, a cash payment, or a contractual obligation to deliver the equity or shares that you are holding, being shares that are financial assets to you, and you are obligated contractually to deliver those to another entity, then you would have a financial liability. Alternatively, if you have a contractual obligation to exchange these financial assets, either they exchanging cash and shares or exchanging financial liabilities with another entity under conditions that are potentially unfavorable to yourself, then you would have a financial liability. Then finally, we have the definition of an equity instrument, which is any contract that evidences a residual interest in the assets of an entity after deducting all of its liability. For instance, when you look at the statement of financial position of an entity and you see a line item called share capital, that line item, share capital, is as a result of the entity having received consideration. In almost every instance, the consideration is in cash from shareholders, where the shareholders are saying, we are wanting to get a residual interest in the net assets of the entity. That means the shareholders are saying, once the assets of the entity have been used to settle the liability, whatever is remaining in the business, we want to have an interest in that. And that evidences that there is equity that they are interested in. Equity being the assets less liabilities of the entity. And by definition from Accounting 101, we know assets minus liabilities is owner's equity. So those equity instruments, the share capital, perhaps share premium, which is no longer very common, all of those line items that are equity in nature are evidencing the shareholders' interest in, or the shareholders' residual interest in the assets of the entity after the liabilities of the entity have all been settled. Now, coming to the distinction between a financial liability and equity instruments. The standard says to us that an issuer of a financial instrument must classify the instrument or its component parts on initial recognition as a financial liability, a financial asset, or a financial asset, or as equity instrument in accordance with two things: the substance of the contractual arrangement and the definitions of a financial liability, a financial asset, or an equity instrument. This means that when you are an issuer of a financial instrument, in all likelihood, you would have probably received an amount of money in exchange for issuing a document that evidences that financial instrument. And that document will contain terms and conditions. The terms and conditions will be interpreted to provide the substance of the agreement. Having interpreted the substance of the agreement, you need to then look at the substance of the contractual arrangement and apply it against the definitions that we have just discussed, being the definition of a financial liability, the definition of a financial asset, and the definition of an equity instrument. Having carried out the exercise of looking at the contractual agreement or contractual arrangement and the substance thereof against the definitions, you will then classify the financial instrument accordingly. Now, coming to equity instruments, the standard says to us that an equity instrument is an equity, or an instrument rather, is an equity instrument if the instrument includes no contractual obligation to deliver cash or another financial asset to another entity, or if it contains no contractual obligation to exchange financial assets or financial liabilities with another entity under conditions that are potentially unfavorable to the issuer. So when determining whether a contract or an instrument is an equity instrument or financial liability, you need to perform a test to say, is there a contractual obligation to do what? To deliver cash or another financial asset? If the answer to that is no, there is no contractual obligation to deliver cash or another financial asset, you need to take it a step further and say, is there a contractual obligation to exchange financial assets or financial liabilities with another entity under conditions that are potentially unfavorable to the reporting entity? If the answer to that is a no, then you have an equity instrument. Likelihood is you're going to be sitting with a share capital line item or another form of equity instrument or equity line item in your statement of financial position. Now, going further to the contractual obligation part of things, a critical feature, which is what we just discussed now, in differentiating a financial liability from an equity instrument is the existence of a contractual obligation of the issuer to deliver cash or another financial asset to the holder. So as an issuer, ladies and gentlemen, you would have, in almost every instance, received an amount of money into the bank account as a result of this contractual agreement that creates a financial instrument. So you would have debited the bank account with, say, 1,000 Rand. Question becomes, where does your credit entry go to? Does your credit entry go to a financial liability account or does it go into an equity account? To determine the credit entry, you need to determine whether, in terms of the contractual provisions, is there a contractual obligation to deliver cash or another financial asset to the holder? Now, the substance of a financial instrument, rather than its legal form, will govern this classification. In an instance where the entity does not have an unconditional right to avoid delivering cash or another financial asset to settle a contractual obligation, the obligation will meet the definition of a liability, a financial liability. That is the cash avoidance test. So, simply put, what you need to ask yourself is, in terms of the contractual agreement, can the entity get away with not paying cash? So you would look at the terms of the agreement and say, as an entity who has received money and debited my bank account, in determining the credit entry, is there anything in the contractual agreement that says I can get away with not paying cash to the other party, be it today, tomorrow, or 5 years from now? If you can get away with not paying anything towards the other party, that means you can avoid having paid cash, which means you would have passed the cash avoidance test. You can avoid paying cash, which means in all likelihood, you don't have a contractual obligation, which means you have an unconditional right to avoid delivering cash. In an instance where you don't have an unconditional right to avoid delivering cash, that is, in an instance where you cannot avoid delivering cash, that means you are obligated. There is a gun to your head that says at the end of a certain period, you are going to have to pay the other party X amount of money. And because you are now obligated to make a payment, be it next week, next year, in 3 years' time, or however many years' time, you then have a financial liability, and the corresponding credit entry at initial recognition will have to be a financial liability. Now, the financial instrument being the contract that does not explicitly establish a contractual obligation to deliver cash or another financial liability may establish an obligation indirectly through its terms and conditions. That's why we need to look at the substance of the financial instrument rather than its legal form to determine the classification thereof. Are there any questions so far, ladies and gentlemen? Oguhle, are you covered?
Yes, I'm covered for now, sir.
Great. Tabisa, are you covered?
Yes, I'm still covered.
All right, thank you. So an instrument, for example, preference shares, that provides for the redemption of the shares on a specific date or at the option of the holder contains a financial liability because the issuer has an obligation to transfer financial assets to the holder of the instrument. So if you have a preference share and you issue these preference shares today, being the 24th of April, and the terms of the preference share say in 5 years' time, meaning on the 24th of April in 2029, you are going to have to redeem these. Then today, on the date of issuance, you already have an obligation because the contract that has been entered into between yourself and the holder of the preference shares stipulates that in 5 years' time, you are going to have to transfer cash to the holder as redemption for these. On the other hand, you could have a contractual provision that says in 5 years' time, the preference share may be redeemed at the option of the holder and not yourself. So that means on the 24th of April, 2029, when the holder comes to you and says, "Hi, sir, hi, ma'am, here is our preference share agreement that we entered into 5 years ago. In terms of this agreement, I have the option today to receive cash from you or to receive equity from you. And today I choose cash." On that date, when the holder elects to receive cash, you will have a gun to your head and you will not be able to avoid payment or transferring cash. Therefore, today, on the 24th of April, 2024, when you enter into the agreement, you need to reflect the fact that as a result of entering into the agreement today, you are already bound by the terms of the agreement to deliver cash in 5 years' time at the option of the holder. An option, on the other hand, of the issuer to redeem the instrument for cash would not satisfy the definition of a financial liability. So if you, as the issuer who receives the cash today, in exchange for the preference shares, have the option in 5 years' time to either redeem them for cash or to transfer the preference shares into ordinary share capital, you can actually get away in 5 years' time on the 24th of April, 2029, you can actually get away with transferring cash. You can avoid paying cash. You will pass the cash avoidance test because you will have an unconditional right to avoid paying cash. As a result of that unconditional right, today, when you enter into the contract being the financial instrument, you will not have an obligation to transfer cash. Therefore, you will not be able to record a financial liability. Instead, you will debit your bank account with the amount of money that you've received from the holder. You will credit a preference share account under your equity section of your financial statement to reflect the fact that this is in substance an equity instrument as opposed to it being a financial liability. Now, when there are distributions to holders of these instruments, whether they are cumulative or non-cumulative, and these are at the discretion of the issuer, yourself as the issuer, then the instrument is an equity instrument. So if the distributions on these preference shares are at your discretion as the issuer, be it cumulative or non-cumulative distributions, then these are equity instruments because, again, the discretion is yours as the issuer, whether you're going to make distributions, whether you are going to cumulatively make these distributions or not. By virtue of the discretion lying with you, you do not have a present obligation to deliver cash. Therefore, you wouldn't recognize a financial liability. Instead, they too would be equity instruments. Now, here's the decision tree on the presentation of financial instruments. I think it'll make better sense once we have covered everything, every class of financial instruments. It is included here for your consumption in your own time as you study, just to see where how to determine whether something is going to be settled in cash or equity, whether it is a financial liability or an equity instrument. Let's take lecture example number 1, which talks to the classification of a contract. The CFO of CA Limited requires your assistance with the classification of a number of contracts that the company has recently entered into as outlined below. The first contract is where the company has issued a letter of allocation, which is also known as rights, to each of its shareholders in a pro rata or in pro rata of their shareholding as part of a rights offer. The letter of allocation entitles each shareholder to purchase 3 shares for every 5 shares held at a consideration of 10 Rand per share in 3 months' time. The market price is currently 12 Rand per share. So here we have rights that have been allocated to shareholders. These rights entitle each shareholder to purchase 3 shares for every 5 shares held, and they're going to purchase each 3 shares are going to be purchased at 10 Rand per share in 3 months' time, and the market price is currently 12 Rand per share. How do you suppose this would be classified? The first thing we'd need to look at, or we'd need to consider, is does the entity, being CA Limited, have a contractual obligation to deliver cash to the shareholders? That's the first consideration. Does CA Limited also have a contractual right to receive cash? That's another consideration. Thirdly, in the absence of a contractual obligation to deliver cash, could we say this is an equity instrument at the date on which these rights are issued? We're going to get into the solution shortly. I just want you to think of these thoughts for now. Do we have any takers that want to perhaps share their consideration? Obuhle Tabisa, what are your thoughts?
Sorry, I was trying to unmute. Can you hear me?
Yes, I can hear you loud and clear.
Okay.
What are your thoughts?
So, Mina, I would say CALTD has no contractual obligation to deliver cash.
I agree with you. So we don't have a financial liability. Agreed.
Don't have a financial liability. I would say this should be a equity instrument.
So at the date on which the letters are issued, do you agree with me that this is just a letter entitling the shareholder with the right to purchase 3 shares for 10 Rand? So as an issuer, we cannot say we have a right. We have not bound the shareholders. In 3 months' time, the shareholder can decide, you know what, I'm not going to buy shares. So the shareholder is not bound by the contract to deliver cash to us as CA Limited. So we cannot say we have a financial asset. And on the date on which we have issued the letter of allocation, the shareholders have not yet subscribed to the 3 shares for every 5 shares held. So can we say they've already bought the shares at that point in time? Okay, are you there?
I'm here.
So on the date on which the letter of allocation is issued, let's say, for instance, I am a shareholder.
Yes.
You are CA Limited. You issue me with a right. Let's say I have 5 shares in CA Limited. You just give me a letter to say, hey, David, in 3 months' time, if you want to, you can come and buy 3 additional shares for 10 Rand per share. Do you agree with me that on the date on which you issue me this letter, I would not have paid you anything?
Yes, I do agree.
So 1, there's no transaction at this point in time. So I wouldn't have paid you anything. I would just be holding this right. And in accordance with this right, I wouldn't have bound myself to say, I owe you 10 Rand. So you wouldn't have a financial asset. You would not have a financial liability because you wouldn't have an obligation to transfer cash to me. And thirdly, I wouldn't have already subscribed for the additional shares. So there wouldn't be an equity instrument either. Do you agree with me?
Yes, now I follow.
So at this point, we don't necessarily have a financial, a financial instrument.
Until you subscribe for those.
100%. Because I haven't entered into a contract.
All
You
right.
just gave me a right.
All right.
Second,
sorry,
yes, ma'am.
David. So now we will start recognizing the equity instrument after 3 months, or we will just allocate. I'm missing something there.
Yes, when I do enter into a contract. So at the point in time where I enter into a contract, it's then that you will recognize the financial instrument.
Oh, okay, sure. Thank you.
Great. Tabisa, while I have you on unmuted, let's take the second one, you and I.
Okay.
CA Limited has issued 20,000, 8%, 1,000 Rand compulsory convertible bonds at their fair value. Each bond is convertible into 2 ordinary shares in 3 years' time. So what has happened is here, as a company, let's say you are CA Limited.
Yeah.
You have issued to me 2,000 bonds. So 20,000 bonds. So the 20,000 there speaks to the number of bonds. You've
Yes.
issued me 20,000 bonds that pay 8% as a coupon rate. 8% of what? 1,000 Rand being the par value. You have issued these to me at their fair value. And these have to be converted to equity or into ordinary shares in 3 years' time. As per the contractual provisions, they must be, it's compulsory for them to be converted into equity or into ordinary shares. What would have happened there is I would then come and pay you the fair value. So you would debit your bank account with the fair value that I pay you.
Yes.
Question becomes, your credit entry then, can you avoid paying me cash?
But now, if it's compulsory, compulsory convertible bonds, yes, in that case.
Yes, yes, you could avoid or not.
Not you cannot avoid to pay me cash because now it's compulsory convertible bonds.
Let's talk about that convertibility. We are saying each of the 20,000 bonds is convertible into 2 ordinary shares in 3 years' time. So in 3 years' time, at the end of 3 years,
Yes.
you are going to say, David,
Capital.
we
Okay.
have come to the end of our bond period. And because we have come to the end of our bond period, I have to now issue you with a share certificate. I have to issue you with ordinary shares. And you agree that ordinary shares are not cash.
Yes.
So you have a right to
Yeah.
avoid making payment. And
Yeah.
because you have a right to avoid making payment, you are not going to have a financial liability. These bonds will be equity in nature.
Okay. So
And the
I'm going to
coupon,
trade it. I'm
you're
going
going
to
to
trade it equity.
you're going to credit equity. You're just going to say credit equity or a credit convertible bonds in equity.
Okay.
Because again, at the end of the bond period, I cannot come to you and demand cash for redemption. They simply have to be converted into ordinary shares. And the coupon payments of 8% will follow the transaction, meaning they will also be treated as equity. In the third instance, we have the company same having issued 20,000 8% 1,000 Rand compulsory convertible bonds at their par value. The debentures are convertible in 3 years' time at a premium of 10%. CA Limited will issue sufficient number of shares that equates to the market value of the debentures on the date of conversion. The required asked us to discuss the appropriate classification of each instrument in the financial statements of CA Limited. Each scenario is independent of the other. We have discussed the two scenarios. The rights, with the first one where there is a letter of allocation that we discussed just now with Okuhle. The rights do not create an obligation on the part of the company to deliver cash or other financial instruments when they were issued. They also don't evidence the shareholders' residual interest in the company. The contracts are therefore neither a financial liability nor are they equity. Coming to the example that we covered just now with you, Tabisa, the bonds must be converted into equity at the end of 3 years. The company therefore does not have an obligation to settle the fair value of the bonds by delivering cash or other financial assets. Nor does the company have an obligation to exchange financial assets or liabilities under circumstances that are potentially unfavorable to the company. Therefore, the compulsorily convertible bonds are equity. The third scenario here, where we talk about the issued 20,000 8%, 1,000 Rand compulsory convertible debentures at their par value, and these being convertible at a premium of 10%. And we get told that CA Limited will issue a sufficient number of shares that equates the market value of the debentures on the date of conversion. In this case here, because in settlement of the debentures, the entity will have to issue a variable number of shares that equates to the market value of the debentures. This is a financial liability, but it's beyond the scope of what you guys are going to be dealing with. This example was included here for completeness sake, but I think it would be best for us not to address it because it's over and above the scope. So in the lecture slides that are going to be shared with you, this portion of the lecture example is going to be removed just to avoid confusion. Is that clear, ladies and gentlemen?
Yes.
All right. Now let's talk about,
quick
yes, sir.
question.
Yes.
This part that you just explained now, does it relate to the part-year compound or it's?
No, it doesn't relate to a compound financial instrument, and you will see why. You will see why it doesn't relate to it. So what the standards say is, if at the end of a certain period or the debenture period, if at the end of the debenture period, the entity is going to need a variable number of shares to settle the value of the debenture. Because you're going to use a variable number of shares to settle, if you look at this case here, what we have is these are compulsorily convertible debentures, agreed, and they are going to be converted at their par value. But we then say, no, in fact, these were issued at their par value. Pardon me, they were issued at their par value, but they are convertible at a premium of 10%. Meaning, if their par value was 10,000, they are going to be converted at 10,000 plus 10% of 10,000 being 11,000. And what we're then told in the second sentence is CA Limited will issue a sufficient number of shares that equates to the market value of the debentures on the date of conversion. If the market value of the debentures on that date is 11,000, the entity will have to issue such number of shares as is equal to 11,000. If the share price is, for argument's sake, 10 Rand per share, then the entity will have to issue a certain number of shares to get to 11,000. If the share price is 100 Rand a share, the number of shares that are issued will vary to meet the obligation being 11,000. In that case, because the number of shares will differ, that creates a financial liability. Unlike what we had in the other scenario where we said each bond is convertible into 2 ordinary shares, we knew that it's going to be convertible for a fixed number of ordinary shares. Here, we have a variable number of ordinary shares. The fact that the number of shares are variable creates a financial liability. But that is just to complete your understanding. It's beyond the scope of your CIMA studies. Is that clear, Obuhle?
Yes, it's clear, sir.
All right, great. Now coming to compound financial instruments. So if you are an issuer of a non-derivative financial instrument, you have to always evaluate the terms of that financial instrument to determine whether it contains both a liability and an equity component. And the standards then tell us that as an issuer, you will recognize, or you have to recognize, each component separately. So the component that creates a financial liability for the entity has to be recognized separately from the component that grants an option to the holder of the instrument to convert it into an equity instrument of the entity. So there are instances where you will enter into a financial instrument as an issuer and you will receive cash. But the terms of the financial instrument will be structured such that you have both an obligation to make a payment and there's an equity component. The standard says, in that instance, you would have to debit your bank account, you would have to determine the financial liability component and credit the financial liability, and also credit the portion of the instrument that is equity in nature. The classification of the liability and the equity components of a convertible instrument is not revised if there is a change in the likelihood that a conversion option will be exercised, even when the exercise of the option may appear to have become economically advantageous to some holders. So at the initial recognition stage, when you classify the financial instrument into its components, being the liability and the equity component, you do not go back to revise it later on when you realize that the likelihood of the conversion taking place is now greater than the likelihood of settlement taking place, or vice versa. Once you've classified the 2 components at initial recognition, you keep that as is, regardless of whether circumstances change along the period of time that the financial or compound financial instrument is ensuing. Let's keep talking through these financial instruments. How do we then split the amount of the financial instruments? We just said now that you would have received a certain amount of money, and you're going to have to split it between the liability component and the equity component. The standard says to us that initial carrying amount of that compound financial instrument, i.e., the amount that went into the bank account, has to be allocated first to the fair value of the liability component, which is determined by measuring the fair value of a similar liability that does not have an associated equity component. And then the remainder goes to the equity component. And how do we determine the equity component? Simply by using a residual. It's determined as the residual amount after deducting the fair value of the liability. Therefore, this tells us that the equity component is equal to the initial carrying amount minus the fair value of the liability component. A simpler way of thinking of this is as follows. When you issue this compound financial instrument, you're going to have money come into the bank account in almost every instance. Sometimes a holder of an equity instrument or a holder of a financial instrument will give you another asset, but in most instances, they will give you cash. And what we know from the accounting equation is that assets minus liabilities is equity. If they give you cash, it means your bank account has increased, which is the asset. You then need to determine the financial liability portion. And if you then say the asset that is in the bank account, asset minus the liability being the financial liability, should give you the equity component. This is essentially what the standard is saying. It's saying the equity component is the initial carrying amount, which is the asset, minus the liability, which is the fair value of the liability component, gives you the equity component. So that's how you will then determine your equity component. Any questions on this before we take a quick example? Ogusha, you covered?
Covered.
Tabisa, are you covered?
Let's do the example. Maybe I will understand more there. But for
Okay.
now, yeah, I'm fine.
You're kind of fine.
Yes, I'm kind of.
Okay, happiness. Let's take a quick example and then we'll come back. I'll ask the question yet again. Yeah. Again, we have the CFO of CA Limited who requires assistance with the classification of the following instrument. So the entity has issued non-cumulative preference shares at their par value. And when we talk about non-cumulative, what we are saying is the preference shares will have distributions attached to them, but the distributions do not accumulate. It doesn't mean that what this means is that the entity being CA Limited is not obligated to issue distributions every year. And in instances where it doesn't pay these distributions, it's not required to compound or add these or accumulate these distributions and ultimately pay them. So they are non-cumulative preference shares. The capital amount of the preference shares is redeemable in 5 years' time at its nominal amount. What this means is that the capital amount can be redeemed in exchange for cash at its nominal amount. Dividends on these preference shares are payable annually on the reporting date. If CA Limited does not declare any dividends during any period, it isn't obliged to declare those dividends in any subsequent year. The required says we need to discuss the appropriate classification of the preference shares in the financial statements of CA Limited. So we have non-cumulative preference shares that are issued at their par value, meaning there's been a debit entry to the bank account of CA Limited, and the debit entry is equal to the par value. The capital amount being the par value is redeemable in 5 years' time at its nominal amount. The dividends on these preference shares are payable annually, but if these are not declared in any period, CA Limited is not obliged to declare those dividends in any subsequent years. How do we classify these? Now, we need to look at the terms of the preference share. And these terms are such that CA Limited has an obligation to deliver cash in 5 years' time to redeem the preference shares. Therefore, the preference shares nominal amount is a financial liability because they are redeemable in 5 years' time. That's the one element of the agreement. The dividends, on the other hand, are at the discretion of the issuer. Therefore, on the date on which the financial instrument is entered into, CA Limited has no obligation to deliver cash in the form of dividends. They can declare dividends year on year, but if they don't declare them in 1 year, there is no obligation for them to declare what was not declared in 1 year in another year. So therefore, with regards to the dividends, CA Limited does not have a contractual obligation to deliver cash. There's no financial liability that exists for the dividends on the preference shares until they are declared. It's only once the preference shares are declared that they become a financial liability. So at that point in time where the preference share dividends are declared, CA Limited will debit pref share dividends in equity and credit preference share liability. That's at the point in time where they are declared. And when they are settled, then CA Limited will credit their bank account to show that money has left the bank account to settle what? The preference share dividend liability. So the debit entry will go against the liability. But at the date on which the preference share agreement is entered into, CA Limited does not have a contractual obligation to deliver cash.
Sorry, David.
Yes, ma'am.
So now here you discuss two things, ne? The
Yes.
preference shares and the dividends on the preference shares.
Yes.
So what is attracting the financial liability on the preference shares is that they have the obligation to deliver in 5 years. So we have that financing component there, or I'm wrong to say that. That is why now we are saying this is the financial liability.
Agreed, 100%. The fact that the moment that they entered into this agreement to say, you as a shareholder, a preference shareholder, are going to deposit money into the bank account of CA Limited. And in 5 years' time, CA Limited is going to pay you back the nominal amount. That
Yes.
creates an obligation on CA Limited to deliver cash to redeem the preference shares at the end of 5 years. So the preference shares would in fact be a financial liability on the date on which the contractual provisions are agreed or entered into between CA Limited and the holder of the preference shares.
Okay.
Okay. Can we take lecture example number 3 quickly and then take a break? We've been going for almost an hour now, and I just want to give you guys a quick break to catch your breath as well. Yes.
Sorry. I have a quick question before we move to the example.
Yes, sir.
Can you please explain again this part of declaring, since these ones are non-cumulative, then once they declare, let's say in year 2, they declare that they will pay a dividend in year 2, just the implication there of declaring the dividend.
Okay, dokes. All right, so let's assume you are CA Limited, right, for a second. Okay. If you declare the dividend, what you would do is you would announce to the market and the shareholders to say, CA Limited has performed quite well this year. And because they performed quite well, they would like to give a return to holders of shares, starting with preference shareholders. And the reason why they're preference shareholders is because they take preference over ordinary shareholders. So before a dividend will be declared to the ordinary shareholders, the preference shareholders will have to get a dividend as well. So they will then say, we are declaring a dividend of 50 cents per share, per preference share holder. And on the date on which they declare this, the declaration on its own creates a valid expectation on the part of the shareholder And because the shareholders now have a valid expectation, it means CA Limited is essentially sitting with a gun to its head to deliver cash in the form of dividend. So at that point, the declaration of these dividends is what creates an obligation on the part of CA Limited to transfer cash to the holders of the preference shares. At that point in time, CA Limited will recognize a financial liability, and the financial liability will be preference share dividends payable or preference share dividend liability. So the credit entry will be preference share dividend liability. The debit entry, the corresponding debit entry, will be a preference share dividend, and it'll be going against equity. It can't be expense. The debit will not go against an expense, and it will not go against an asset. It has to go through equity because the dividend is being paid to shareholders in their capacity as holders of these shares. So the debit would be debit preference share dividend in equity, credit preference share dividend liability. That's the declaration part of it. When they now make a payment, the payment, as you would agree, would reduce the bank account. So there would be a credit entry against the bank account. But why is there a credit entry against the bank account at that point in time? The credit entry goes against the bank account in order to meet the financial liability, the obligation created by the financial liability, which was what? The declaration of the preference share dividend. So the debit entry would go against the preference share dividend liability account. Is that clear, Ogushe?
Yes, I think.
Thank you. Let's now take lecture example number 3. Lecture example number 3, again, the CFO needs assistance with classifying the following instruments. CA Limited has issued cumulative preference shares at their par value. The capital amount of the preference shares is non-redeemable. Dividends on the preference shares are payable annually on the reporting date. If CA Limited does not declare any dividends in any period, it is obliged to declare those dividends in any subsequent year. So it's the opposite of what we had in lecture example number 2. In this case, the preference shares themselves are not redeemable. So at the end of however many years, CA Limited is not having to transfer money to the holders of preference shares as a redemption payment. However, year on year, CA Limited is obligated to be making declarations of dividends on these preference shares. In us discussing the appropriate classification, we established that the terms of the preference shares are structured such that the entity CA Limited has no obligation to deliver cash to redeem the preference shares. Therefore, the preference shares are equity instruments. The dividends, on the other hand, are declared compulsorily. That is, the entity has no discretion when it comes to declaring them. Therefore, the entity has a contractual obligation to deliver cash in the form of dividends. CA Limited should therefore account for the equity component of the financial instrument by subtracting the fair value of the financial liability, that is, the fair value of the contractual obligation to deliver cash in the form of dividend, from the initial carrying amount of the financial instruments as a whole. So on the date on which the preference shares are subscribed to or the preference share agreement is agreed and signed, CA Limited will receive X amount. They will then have to establish a fair value that is representative of the contractual obligation to deliver cash in the form of dividends. They will then have to subtract that fair value of the financial obligation or financial liability. The financial liability's fair value will have to be subtracted from the initial carrying amount of the instrument as a whole to arrive at the equity component. And that will then determine how they split the two amounts up. We're going to have lecture example number 4, which I believe has numbers. Does it not? It's still also a discussion question, but I'd like for us to pause here for a moment. It's 7:15 on my watch, ladies and gentlemen. Can we take a quick 5-minute leg stretch and come back at 20 past?
So, sorry, David, before
Yes, ma'am.
we take
Before
a
we
break.
part.
Yeah,
All right.
before we part. Because now we are writing the objective test, like it's not like a discussion, it's a multiple choice question. So how do you think they are going to give us these options after this examples that you did? Like I'm trying to think on the exam or on the test, how they are going to test all these scenarios.
All right. There is an example that we are going to take further along. There is an example that we are going to take along. I'll just to clarify, just please will you park that question, right? There's an example that we're going to take that has numbers in it, and you will see how the numbers come into play. So here we're just discussing the classification, the considerations of classification. We're going to get into the measurement aspect of things, where you're going to see how the measurements play out.
Okay, thank you.
All right.